Hello, thanks for joining us. With me today to help make sense of yesterday's budget is once again John Endacott, Tax Partner and Head of Wealth and Succession here at PKF Francis Clark. We had a record number of sign-ups for today's webinar, which I think reflects the level of anticipation around this budget, and also hopefully the fact that many of you have found John's analysis useful on our previous webinars. So it's great to have you back with us today. What are we going to be talking about over the next 45 minutes to an hour? In a moment, John is going to give us his key takeaways from yesterday's budget. Then we're going to dive into some of the major policy announcements from a business point of view. So we will take a look at the items you can see on the slide here: property, savings and dividend income, profit extraction for business owners, changes to capital allowances, some thoughts about business rates, changes to employee ownership trusts for business owners who might be considering selling their business in the next few years, a change to inheritance tax for business owners, including farmers, and some thoughts on the tax gap. As always, John will be taking some of your questions later on in the webinar, so please do post them in the usual way through the Q&A tab on your screens. And if you're watching the recording of this webinar, you will be able to find a contact form on the Budget Hub on our website. So if you'd like to get in touch with us about any issues you're concerned about via that channel, we will do our best to get back to you and assist you if possible. So, John, good to be back. I know you said in advance of the budget that you were feeling fretful. I'm sure you weren't the only one out there. Are you less fretful now than you were before?
Oh, no, that's a good question, Gordon. I mean, there was an element yesterday afternoon of what was all that about and how do we adjust and what have we just kind of been through. And so there's a large part to this, which is what's kind of going on here and trying to understand it that we can talk about now, and I'll run through. And that leads to, so yes, less immediately fretful, definitely, but the worries remain in terms of where we're going with this, and hopefully we'll draw some of those things out, and we'll draw them out with trying to explain what we're concerned about and why, and what people should be taking away and kind of looking at. And that would be interesting to get people's perspectives as well, and to take it from there. So should
Okay,
we kick
great.
off with a bit of a
Yeah, that sounds like a good plan. So let's imagine I'm a business owner. You're my advisor, John, and I've come to you today. What should I make of this budget as the dust settles? What should we be concerned about? What are your main thoughts and
Yeah,
takeaways?
thanks for that, Gordon. That's probably the best way, and the best way we'd like to view it, because we don't want to get dragged into too much of the politics of some of this, and yet there's inevitably a large amount of politics and other things to kind of consider. So, I mean, the first question is, how significant was this budget? Bearing in mind, it seems to have been all that many clients were talking about and dominated kind of waking thoughts and conversations for a long time. People have been very busy kind of taking actions. What's kind of happened? And we're as ever grateful to have so many people joining us, and most of these people have sensible lives and don't spend all of their time thinking about budgets. And so let's start with this picture from the OBR's documents, kind of looking at this budget in context of the last 15 years. And that's probably a helpful place to start, because, whilst people like me can remember where we were and what we were doing on these different budgets and what kind of happened, most people have just been going about their lives enjoying themselves. And given the build up to this and everything that's kind of happened, you'd expect to see a massive bar going one way or the other on this chart, which kind of said what has happened here, and then asking for some explanation of it. As it is, the November 25 one is the little yellow, you can barely see it smudge on that graph. So the purple is fiscal tightening, and his budget's getting much tighter and money being taken out of the economy. And the green ones are loosening and money being pumped in. you can see that, June 2010, the first coalition budget and the austerity budgets under the coalition all show really pretty much fiscal tightening and raising money. And then things get a bit easier across the Conservative government years. A massive splurge with COVID, then trying to redress and tighten and get a grip on things and going through the whole mini budget and everything else that's there, and then starting to get to loosening with the cuts in employees' national insurance, really under Jeremy Hunt and some of the other measures, and then you get to where Rachel Reeves was last year in October 24 with a massive fiscal loosening. So you've got all of that kind of happened, and here it's kind of like, yeah, you know, in a way, almost, it's unfair to say nothing happened, but much less happened than anyone might have been expecting. The FT editorial this morning described it as a stopgap budget, and that's an interesting way to kind of get down to, all that was done was the absolute minimum that had to be done pretty well to kind of get through until next year. And so if one kind of really summarizes it down, the money that needed to be raised needed to cover the U-turns on winter fuel and the cuts to PIPs, which are described in the papers as summer welfare reversals. That then needed to raise some money for the ending of the two-child benefit cap, which is described as new welfare policies. And then the other thing that happens in all of the numbers is it's assumed that fuel duty will go up every year because sometime in the Gordon Brown era, we came up with the fuel duty escalator and then no one ever implements it. So you have to find that money from other taxes for that not to happen in order for the books to balance. And Rachel Reeves was desperate to give herself some more headroom because that seemed to be what the feedback from the bond markets was saying is, we don't really believe a lot of it, but if you give us a bit more headroom, we'll be a bit kind of happier. So that's what she's trying to find. She's balanced the numbers way out, and if you look at my blog on the website, the overview one, it goes through some of that, trying to explain it in a bit more detail as to the details of the numbers. But broadly, she needed about £7 billion a year for the next few years just to cover what had changed. And then there's also some problems on special educational needs in local authorities, and government needing to find some money for that. So there's a few other bits and pieces. And broadly, what I'd prefer to talk about a lot today is how those things are being funded and the tax changes introduced to deal with those. What we have is a large number of tax changes due to come in further out, which we'll touch on now. But, will they happen? What will happen is an interesting question.
Yeah, that's interesting, John. So the bars on this chart are showing us the OBR's forecasts over the 5-year period. I think what you're going to come on to talk about is the makeup of where the fiscal loosening and tightening happens in those different years. So perhaps if we move on, we can look at which taxes are going to bring in the revenue that Rachel Reeves needs to balance the books.
Yeah, thank you, Gordon. I mean, this is a busy chart, but I think it's helpful. I think it's a helpful way of trying to look at the world a bit. So this is looking at how the tax take is changing each year, and again is got a nice retrospective going back to kind of 2010, which is its base. So this is only changes in tax revenue from 2010 onwards. So obviously in those halcyon days, we were really actually, moderately taxed, it turns out, who knew? But, and for all the tax avoidance activity that was going on then, actually, that looked like quite good times. And it's useful to look at the various colors to see what has happened. And this is showing that, we've been through a period of what are called the austerity years, and then the years afterwards when people felt that taxes were getting higher and higher and higher. And actually, on the nature of this graph, they look like the foothills of the mountains, and as you actually look in hindsight, we haven't really come up very far, and we're still looking at a bit of a cliff face that we've really got to go up. And then you have to say, how realistic is some of that when you bear in mind there's an election somewhere in there, and it seems possible that another political party is going to say they're not going to put taxes up and they are going to cut spending in some way. So it will be interesting to see what happens on that. Some of the points worth drawing out. Um, the the composition of the orange VAT number has stayed much the same, and VAT was something where nothing much happened in this budget. Now you can come back to some of that um, being about inflation and not wishing to push costs up. But actually, governments have just steered clear of VAT for a very long period of time. And the number that has been pushing up, and in these big bars going, on the right hand side, income tax is really where lots of the heavy lifting is coming in. And most other things aren't making too much difference, other than we've had a reduction in oil and gas, and fuel duties continue to drop as cars shift across. So it's helpful to reflect on where that's going. Corporation tax, the receipts have increased, but given latest figures, we'll touch on that a bit more later on, but still pretty small compared to income tax, just because of the nature of the population, really, of the companies.
You mentioned income tax there doing the heavy lifting. That was certainly by far the biggest revenue raiser announced yesterday, the 3-year extension of the existing 6-year freeze on personal tax thresholds, which we'll come on to in a moment, I think. But we're not going to dwell too long on that in this webinar, because we're looking at things more from a business perspective. We can see just before we leave this slide, anything below the horizontal axis is a decrease in the relative tax take, and you can see fuel duties of the light blue color there at the bottom have been in decline for some time, and expected to continue declining. That's a topic you've talked about on previous webinars, I know, John, as partly reflecting the freeze in fuel duties that now extends back about 15 years, I believe, but also the general transition away from combustion engines to electric vehicles.
Yeah, and we're showing a bit more what else is kind of happening, to see the nature of the shift in new vehicles. The minute you Google and you ask a question, how many cars are on the road, you get to a number like 34 million or something like that. So you also appreciate the sheer scale that electric vehicles do not make up a very large proportion of the car fleet. You might have a slightly different viewpoint if you looked at the car park at Centenary House, Francis Clark in Exeter, or outside Pennon, and so you'll get to different mix in different places. But electric cars have been coming through, and there's a significant one. Where does that go next? Who are likely to be the provider of those electric cars? There's a whole load of aspect about that. The government has come up with a plan to start trying to find some revenue from electric vehicles to fund road tax. But how serious they are about that policy remains to be seen. It feels like the minimum they got to do to keep the OBR happy that it's a serious policy, and it's pushed out for when they need to pick it up. I mean, that's another one which is a 2028 kind of one. And as you were saying, Gordon, my take is, there's not much point us doing immediate commentary on changes that are coming in from April 2028 onwards, on the grounds that there's much more time for people to consider and think about some of that than to have to react kind of overnight to that, really. So I'd prefer we focus on some of the things that are kind of here, and people will form their own views as to what they think is likely to happen on the kind of electric car market, and the push and pull of the government trying to incentivize it, whilst at the same time them raising taxes on it as well.
Indeed, yes. So we just thought it'd be interesting to share this brief slide from the RAC, which does sort of visually illustrate the increasing uptake of electric vehicles and hybrid vehicles. So clearly that underlines the need for the government to start doing something in terms of replacing the lost fuel duty. But let's move on, John. We did mention that the freezing of the thresholds was the biggie, as it were, in this budget. And I think we can just give a brief illustration of the impact of this measure. This slide is not brand new. It's from the Institute for Fiscal Studies, but it does show the impact of the freeze, the already announced freeze, which has of course now been extended even further, in terms of the estimated share of employees in selected occupations who pay the higher rate of income tax. So just to pick out one or two highlights on here, you can see nurses on the far left there was almost a minuscule amount previously back in the early 1990s. It's getting on for about 13 or 14% of nurses are expected to be higher rate taxpayers by 27-28, and of course the freeze has now been extended until 2030, 2031. You've also got teachers there. It's around about 1 in 4 teachers are on track to become higher rate taxpayers, and about 37% of police officers as well. So I think, John, your thoughts on this slide?
I think it's helpful. I mean, a couple of observations I'd make. I mean, from memory, 93, 94 is a reasonable benchmark. It's not a year where I think the higher rate threshold was particularly high relative to the working population. I think it was, a reasonably average year in that kind of one. So you can see the stark difference over there. And the other thing, I think 27, 28 is a reasonable one to compare against. I'm deeply unconvinced that the freeze will extend beyond 27, 28. So I think it will extend as far as that. The idea this freeze is going to happen beyond that, I just can't see it particularly. We're just announcing, things that are just far into the future and are just trying to balance books, and make numbers look okay. So I think that will be stark, and it will be, if things turn out the way that that is portraying, and this is a reputable source and people having done it, you can see that that is likely to be a major issue at the next election, where people will be really feeling it. So, and that gets to the whole context that broadly what we have is taxes being raised in order for more money to be spent on welfare. It depends on how those people react to it.
Okay. Well, yeah, you mentioned the sort of credibility question there. I suppose in terms of how many of these tax raising measures will come into effect further down the line, and that brings us on, I think, quite nicely to the market reaction, and the need to keep the bond markets on side because of the amount of borrowing that the UK government and many other governments, to be fair, around the world has to do. So did you want to? This is quite a complicated slide, John. I realise for many people, so you might need to do a little bit of unpacking for us here.
Oh, okay. Well, yeah. I think this is a very important topic, and you're right. This is a busy slide, and it's a complex area. And the general conclusion is that most people don't really know a number of the factors kind of going on as to what might happen. But if we look at it in the context of a typical business, and you consider the life of a typical business, and they need to borrow money, where might they go to borrow money? They'll go to a high street bank as a first kind of port of call. And that's a main source of funding. They might otherwise fund it from family money or other kind of money available. If neither of those kind of sources are available, they might go to more secondary lenders who would be prepared to fund them, but might want a higher to charge a higher interest rate and have stricter terms. And then you get increasingly desperate as to where you finance things from. So broadly, businesses only end up in deep doo-doo, without talking on behalf of my business restructuring colleagues, they only end up really in the complete pits once they've exhausted all the sources of funding kind of available to them. The British government was in a very strong position on the way debt was issued over the kind of 2010s, because we hit the financial crisis in quite a decent position in terms of our government debt position. And the government debt has been quite well financed to date. And then there's been the other complicating factor that we sold an awful lot of the debt to the Bank of England, who basically funded it, and we were able to kind of fund it. You've got the further factor that because we have our own currency, we can fund in a way that, say, the Europeans or the euro can't. So we've got all these kind of factors going on that kind of complicate it and make us look reasonably attractive in terms of it. But what is going on is increasingly we are not giving people the guarantees that we might have given before in terms of index linked, where you've got to, that's costly money to raise. So you can get quite a good deal, but you've got to give people guarantees. And we are moving the money to increasing amounts of more short dated kind of funding, because shorter term interest rates are better at the moment than longer term interest rates. So that works if longer term interest rates are going to come down, and when we get there, we're in a better position. But the danger is what we're doing is we're just pushing our luck, and sooner or later there gets to be a bit of a crunch. Now, the siren voices, to use that expression, and a number that you can speak to will say, well, this is imminent and there's a problem kind of coming up and we're going to see some difficulties more immediately. There isn't much sign of that at the moment, and the bond markets reacted reasonably calmly to the shenanigans of yesterday. But what you're likely to see is an increasing amount of them going for more short dated, and the maturity of the gilts dropping, as well as interest rates kind of rising and that balance shifting. And we are seeing that this could be a very, very long-term process. There may be nothing to worry about here, but it's something to kind of keep your eyes on. And I'm sorry I'm not explaining every last kind of bit of detail on there, but there's a lot of different aspects to it and a lot of different government responses that could be made. It's a concern to keep an eye on.
Indeed, I think you make the point there, John, that a big risk to all of this, to all of the forecasts, is what happens to interest rates, because because of the huge amount of borrowing that the government has nowadays, and in the OBR forecast document that was released yesterday, I think I'm right in saying that a 1% rates shock would lead to £17 billion increase in debt interest spending, which is quite phenomenal, really, and mind-blowing figures when you think about that in comparison to some of the tax raising amounts that we're talking about today. Just by comparison, I think the mansion tax, the council tax surcharge on high value properties, is forecast to raise something like £400 million a year. So really small change in comparison to what the government could be facing if interest rates move in the wrong direction. So sobering thoughts there, John, but did you want to get stuck into some of the more detailed measures that were announced yesterday?
Yeah, let's talk about where the money is coming from in the short term, because I think those are the things that will interest people in particular here. I mean, broadly, the government is spending more money up to a likely next election date and has announced a few tax rises that will then fund it. And I really wanted to talk more about those aspects.
Okay. So I'm not sure if we have a slide on that one, but did you want to?
Yeah, no, you carry on. So let's start with the rental
did you want to
interest
get?
and.
Yeah, sorry. Where the tax is coming from. Did you want to say more on that before we look at
No, I
the
think
more
it
detailed
comes
measures?
through. I can pick it up as we go along. Go on.
Right. Okay. Thank you.
And there's detail in the blog, which kind of, so I did some maths in the blog, and I toyed with whether we replicate a lot of it here, but we'll leave other people to read that at their leisure.
Good idea. Okay, so first of all, I know we have a blog on this from our colleague Steve York, but let's take a closer look at the changes that were announced yesterday to the tax rates on rental interest and dividend income. Talk to us about that, please, John.
Yeah, so one of the interesting things here is the similarities in some ways with underlying policy objectives between the Conservatives and Labour on what's happened. So Jeremy Hunt was trying to reduce the gap between how employment income was being taxed and self-employment income, so income from working, with how, should we say, other income is being taxed. And the approach to that was to focus on reducing employees' national insurance. Okay, so it was tax reductions. It wasn't putting other people's taxes up. It was reducing employee national insurance and then trying to get that differential to come out better, which is what a lot of the people have been saying we need to work at. What we have is this government trying to achieve the same policy objective of reducing the gap between how employment income is taxed and how non-employment income is taxed, but by raising the tax rate on the non-employment income. And clearly that wasn't the plan, and that it's been forced on it by the additional kind of welfare policies and the way the government has had to kind of change tack. But so what we've seen, and then because we had the cuts in employee national insurance coming in at 2%, I think the 2% is seen as a kind of sensible kind of number to adjust. And we had all of that build up of will the government cut employee national insurance and raise income tax for everyone by 2%? And so what we've seen is that not happen because that was felt to be a manifesto breach. So we're just whacking income tax up on savings and investment income. So rental income and interest income, if people are extracting that from their companies or are earning it from businesses like property businesses or whatever else, will be taxed at a 2% higher rate from April 27. So, 22%, 42%, 47%. Once you go further up, there's similarities in particular with the employment income. Dividend income, 2% has been put on to the basic rate and the higher rate, but not onto the additional rate. Those dividend rates are really quite nasty because the bit that everyone needs to remember and the complexities of the system we've got into, we now have a classical taxation system, which means that we tax both the corporate profits and then we separately tax the dividends, and you get no credit for the corporation tax paid by the company against your dividend income. So those tax rates are being applied to 75% of the profits if you assume the company's paid 25% corporation tax. So they're pretty steep and they're quite nasty. Clearly it was felt that it was too hard to not worth increasing the 39.35% because it's already pretty high. If the government had any desire to simplify anything, having tax rates that are 39.35% pretty well sums up the UK tax system. I mean, how'd you get to that one?
I think we've got a slide here as well that just illustrates the impact.
Yeah, and this is a useful one to try and pick up. I haven't worried about down to below the level of the personal allowance, but you've got a position whereby actually, for a large part, once you're into higher rate or additional rate, where we've got rental or interest income, it's been taxed at the same effective marginal rate as employment income now. It isn't for those in the basic rate band where we've got 28% versus 22%. And you actually get, because of the way the clawback of the personal allowance works, if you've increased the income tax rate, you actually get to a slightly sharper rate on that one. It's marginal, but it's about another 1% coming through. So there's plenty for people who might be in impacted areas to need to consider. And if we maybe flip on.
Okay, no, this all feeds through into questions for business owners when it comes to profit extraction. I'm sure there'll be lots of conversations going on between you, other colleagues and clients in the coming weeks. So yeah, did you want to give us some thoughts at this stage, John, on what business owners might want to consider?
Indeed. And I think where we're getting to for most profit extraction is that the rates now between whether people are taking salary or bonus or taking dividends are pretty similar. As I've written at the bottom of that slide in a very technical fashion, lots of assumptions. And there's plenty to kind of need to consider there. Where you've got a 19% corporation tax rate, you will get to a better position with a dividend because the corporation tax rate is lower. Therefore, the overall dividend is higher as a percentage of profits, and therefore the tax rates work better in terms of the way it comes through. But broadly, we're getting to a position where there isn't much difference um, between those rates, and that may not, individual circumstances are different. Business owners need to consider it. But even on wider business structuring, looking at what else businesses can do, even if you're looking at things like family management, buyout arrangements, how you structure that, these things will factor through. And whilst you can look at some of those and go, yeah, the numbers aren't that much of a difference, um, getting the profit extraction policy right will save a reasonable amount of money because the tax rates are quite high.
Okay, thank you, John. Another change or other changes that were announced yesterday that will be of interest to many business owners also concern capital allowances. And I know our colleague Heather Britton has written a useful blog on this very topic. But did you want to just talk through the next slide, John?
Yeah, I mean, this is an interesting kind of change, and we spent some time talking about yesterday. So, I mean, I would say the changes to capital allowances and the way they've been done reflect a government trying to raise money, and this is a pretty classic way of trying to raise money when you need to. So what this example shows is what we've had introduced is a reduction in the writing down allowance on pools of expenditure from 18% to 14% with a new first year allowance. Now, these are going to apply really to unincorporated businesses or to other businesses where they don't get full expensing. So there's a leasing angle on that. But mainly we're talking here about unincorporated businesses, and we're talking about businesses where they've already utilized their annual investment allowance. So this should probably say lots of assumptions as well. But the purpose for having these numbers, which Heather knocked up and I've just rounded, is over a 5-year period, you'd look at this and go, well, not really much difference at all. So what kind of stuff. And that's a reasonable kind of one. And yet this is a net revenue raising policy. The what we were seeing on the dividend and interest tax rates might raise a couple of billion a year once it's getting going. This raises £1 billion or so a year. So these are significant um, raising policies in terms of the government needing money. Who's paying that? Well, the people that are getting caught by this are people with large existing pool values. So this is all to do with what happens on historic expenditure. And the government is effectively saying, um, we want to incentivize new expenditure. And if you've already spent the money, tough. We don't care about any of the tax incentives that you might have thought you were going to get. You're fair game, and go out and spend some more money. So there is an attempt to try and incentivize a bit more money spending here, but it's confused. It doesn't really quite work through it, and it's inconsistent in terms of where it fits through. But that's what it's kind of all about. All I would say is, yes, there's some positives in this policy in terms of the way it works, but overall it's a net revenue raiser. So yeah, go figure.
Okay, thank you. Well, again, John, another complex area there, which I'm sure Heather and other colleagues in our tax team will be speaking to our clients about very soon.
And anyone looking to spend significant money as an unincorporated business should be making sure they touch base with us and have a conversation with whoever their main point of contact is before they do it at this point.
Good point. Okay, thanks, John. Moving on, did you want to say a bit about business rates?
I would. And I mean, the business rate policy was announced in the autumn budget last year, and then there's been further kind of detail on it. And broadly, the government's aim is to try and boost lower rental rateable value properties, um, at the expense of higher rateable value properties. And there were some comments in the budget speech again about this yesterday, talking about warehouses and Amazon and people like that. But where this seems to really come through, I mean, there's been a lot of pushback on this. And I mean, it's interesting, there's no sense of a government U-turn on this kind of one. This was all part of the strict measures when the government was saying we've got to get the finances on a sustainable footing. The key part of this policy on business rates reform is it had to be revenue neutral. The government is not prepared to put any money in from other tax sources to try and sort the mess out that is our business rate system. So all it's saying is, if you're Tesco's, you have to help support some, small, village shop type idea. They're probably already benefiting from rates relief. So maybe small shop on a high street in a regional town. Um, it's causing lots of problems, and where I really see the issue, and I was kind of this morning walking the dog through Princess Hay in Exeter, for those that are kind of familiar with it, walking down between the former Debenhams store and the empty restaurant units the other side, the former Cafe Rouge, Meat 59, which was whatever hamburger place was before then. Those ones that have all been empty for ages. These are the ones where you get to the kind of rateable values that, if we're not careful, we're just making it harder and harder for people to regenerate the town centres. And so in a way, the business rates policy probably helps smaller regional towns. And then as you get to larger retail centres, or larger kind of flagship stores or anchor tenants, it's very difficult to get those to work. And I've spent quite a bit of time with some clients in some particular parts of the southwest and South Wales, working on trying to resolve some of these. To give you an idea where you might want to kind of get to, these came from a kind of daughter. So the former Cafe Rouge restaurant in Exeter has got a rateable value of 81,000. The former Meat 59 is 101,000. These are the kind of numbers that we're kind of dealing with here. And it is disappointing from my perspective that the government has chosen to raise additional money and throw it at a different part, and where it could use it to prioritize growth and support business, it has not chosen to do so. There we are.
Okay. Yeah, no, that's an interesting point you make there, John. I'm sure many of our friends in the retail sector would be keen to point out that Exeter remains a thriving retail destination and a great place to come and do your Christmas shopping. But as you say, not immune to the challenges of empty units that are affecting high streets up and down the land.
And there are plans to make the bit of Princess A, even though I was talking about better, and things that are in train, but we're not supporting the people trying to do that very well. It's just, and don't forget, business rates is a bill that people have, whether they're making any money or not. That and it's difficult when you've got costs of fitting out properties and having to meet it the whole time.
So definitely a big issue, one to keep an eye on. Any more thoughts on business rates, or
No, I
shall
think
we
I
carry
think
on?
I've had enough of a rant and a whinge.
Okay then. Well, I think the next item on the agenda was employee ownership trusts, which I think again will be of interest to many business owners. We have seen a big increase in the uptake of this form of transaction. I know our corporate finance colleagues have been very busy in recent years helping business owners particularly those who I think are conscious of the legacy that they want to leave. But also there are have up to now been very significant tax advantages as well of selling your business to an employee ownership trust. So for those who may not be that familiar with it, John, did you want to start off by just explaining the concept and how it works?
Yeah, I felt it helpful just to try and explain the structure and then pick up on a few points. So broadly, if you're looking at exiting from a business, when I was much younger and did more of these kind of things, you might have options that you could do a flotation on the public markets, you could do a trade sale, or you could do a management buyout. And the price of what you like to get varies depending on what type of transaction you're doing. And the management buyout tended to be the the softer option, and where you'd have to look at even sort of vendor loans or leaving money kind of behind and the rest of it. And then you can move into variations of that, of things like family management buyouts and all the different types of ways that we might structure matters. When you come to EOTs were a different idea, driven by the Cameron idea of trying to promote more employee ownership structures. They have undoubtedly been, abused, and certain kind of ones there, but it helps just to start off with the concept of what happens. Um, the owner sells their shares to an employee ownership trust. That's just a trust they're set up. The trustees have no money and no ability to do it. So he's just shifted his shares across, or she has. They have shifted their shares across to the trust, and they've got a loan back, and it's just an IOU, and it's very hard to enforce that IOU because who's got any money to kind of pay it beyond what's kind of there. And the idea is, as the company makes profits, it pays money up to the trust, and the trustees are able to repay the loan. If you're a trustee in that position, you own some shares, but you owe a large amount of money to the former owner, and you don't actually have much money. It's not desperately attractive, and the whole thing is quite hard to get to kind of work and hang together. Um, there have been a lot of transactions that tend to focus on the construction sector for this, mainly because the difficulty of funding those as a management buyout type idea, and ways of trying to get some of these structures to work. But they have been pursued by certain people, and mainly the issue has been about valuation. And HMRC started a clampdown to try and attack the people that have been selling some of these things in ways that were different to how we might have approached it. So there's a complex kind of backstory to here. There's also the tax relief is slightly curious, and it's very favourable to the owner, who then doesn't have to pay any capital gains tax on the disposal of the shares, but the employee ownership trust takes the shares at their historic capital gains tax value. So there's still a latent tax charge for the trust. So it only really works if the trust is not particularly looking to ever sell the shares or exit out. Um, so complex and a lot of need for advice. Should we move on to some other? I think that's enough kind of ones there for the people that are.
Absolutely, yes. So should we just run through what was announced yesterday and the changes that are coming for anyone who may be considering selling their business to an EOT?
So the key, let's take this in slightly reverse order from the bottom of this slide up. Then you're right. That's a better way. So, as I said, at the moment, disposal proceeds are not taxed. It's a slightly curious kind of arrangement. You receive the proceeds, and then they just have a get out of jail free card, and they just go not taxable. Leave me alone. What's going to happen from here on in is that you'll get that special relief on 50% of the gain, but not on all of the gain, or 50% of the proceeds, but not all of the proceeds. And that pushes you down to 50% of the main rate of 24%, so a 12% effective tax rate. If you look currently, entrepreneurs relief on gains up to £1 million, business asset disposal relief, entrepreneurs relief and old money, but business asset disposal relief is currently 14% on gains up to £1 million. That will be going to 18%. So in a way, what one's coming up with is a rate that's kind of similar-ish, and it's a relatively simple fudge to kind of get it there. The bit that I am struggling to understand, and the OBR clearly must have had some difficulty with this as well, is if you take the figures at face value, the government is suggesting that 4% of all gains made in the UK are EOT disposals. The figures from March this year for CGT receipts was 19.7 billion, so 20 billion, and yet the government is predicting that this measure will raise 800 million to £1 billion or so. It's very hard to take that number entirely seriously. This feels like revenue protection, not revenue raising, but it's in the camp of revenue raising. So it's an interesting one. And certainly from what we're seeing, there are not the level of transactions for that to make sense, but there we are.
Okay, thank you, John. Whilst we're on the subject of employee ownership trusts, we have had a couple of questions from our audience, so it might be a convenient point to turn to those. Thanks to all of you who have submitted questions. Don't forget you can still do that through the Q&A function, and John will try and pick up a few later on if we do have time. But Carl has asked, are there any changes to existing EOTs?
No, this will be an impact on transactions that happen after yesterday. There is an HMRC effective clampdown on some of the planning that's already happened, and there are steps and things that people should be considering to look into in terms of how they approach the governance and what they've kind of done and how they approach it. So there may be things that people should still be considering in terms of an EIT, but there is nothing in the tax rules that is retrospective and going back and impacting on what has already happened.
Okay, thanks for clarifying. And Andrew, thanks for your question. You may have touched on this already, John, but just to take it directly, Andrew asks, if the benefit of using an EOT has been reduced by half, can the chargeable element then be relieved by business asset relief?
Yeah, I would have thought so. I mean, I haven't looked, but I mean, logically, it would follow if you've got business asset disposal relief available to you, that would then be a gain that should be qualifying for that. I'm not sure there was that level of detail in it. It's a reasonable point, but yes, logically, it would seem hard. Why would a government stop that being kind of available?
Okay, well, thanks for those. And just to move on, I know a very big issue for many of our clients since the last budget has been inheritance tax, and we do have a lot of useful content on our website in the succession planning hub, if you haven't already looked at this, particularly around the changes to agricultural property relief and business property relief. There was some news on that yesterday, John?
Yes, so we've been hopeful that there might be some concessions issued by the government. That the government, frankly, just didn't really have the money and wasn't interested in providing it to the people that were impacted. What they did do, though, was they did give one concession, which is still significant and will be particularly significant for some people, and felt like the minimum that they ought to ever do, which is to make the 100% allowance transferable. So the way the rules are going to work from April next year, and it's hard to see now that the government will change them. So I think they will come in April next year as they have now been announced with this change. So as and when they come in, what you've got is £1 million allowance per individual where you'll get 100% relief. And then above that, you get 50% relief. And so on that amount above £1 million, what you've got is an effective tax rate of 20%. It's slightly more complicated than that because of the way the nil rate band and other bands work. But broadly, that's the crux of it. What the government has been reluctant to do is to make this 100% allowance transferable between spouses and civil partners. Now, the nil rate band for inheritance tax has been transferable since 2007, 2008, 2007, I think. And the residence nil rate band has always been transferable. So it was very, very odd that it wasn't transferable. And it would have led to a lot of very complicated will arrangements and planning of trying to get the relief of structuring that all felt a bit unnecessary. The big difference, and the reason why the government was probably reluctant to make it transferable, is that there is a one-off, say, set of beneficiaries from this policy change. I mean, it's all relative, I'm not sure, but for those people who are already widowed or widowers, then they are able to get an extra £1 million allowance from, even though the death was before the policy ever came into account, into position. So, if I was to die in June next year, and my wife had already died before, had already died by now, so I was already a widower, then at that point in time, whoever was dealing with the death estate would be looking at my £1 million allowance, but I'd also be able to claim the £1 million allowance from my deceased spouse. So this costs the government, I don't know, 70 million a year or whatever it is, because they're actually picking something up. So absolutely small change in the scale of life, but released through kind of gritted teeth and peeling the fingers back to allow what feels like just an eminently sensible kind of change. For those people that have been particularly worried about some very old, particularly very old farmers, where there is not much available to them in terms of gifting assets away or doing things, because, let's say you've got a farmer in his 90s, there's a decent chance that those people, a farmer in his 90s is a widower already. And therefore, actually, this is potentially quite significant to some people. Is it enough? No, not really. One would have liked a lot more, and there's some other things that could be done. But for those people, they should be talking to us or whoever else they're talking to, and getting some advice on that.
Certainly, and I'm sure conversations, I know conversations have been happening over the past year and indeed since yesterday, particularly with our colleagues in the agriculture and landed estates team. So as John says, everyone's situation is different, so well worth getting advice if you are likely to be affected. John, we're coming towards the end now, so just before we do take any further questions from the audience, I think you wanted to look at something which might be of more interest from a corporate tax perspective, and that is the tax gap and any unclaimed revenue that HMRC might be going after.
Yes, so I think if we go back to the where is the government finding the money from for the next few years in terms of trying to make the numbers add up, it's putting additional tax on property income and interest income and dividend income. It's squeezing some more out the capital allowances system. And we go through those kind of changes coming through. The other one that it's saying is it will get more money. So it's getting more money from EOTs and capital gains tax. It's saying it's quite a large number, and I'm unconvinced. There's a whole load of other smaller changes that are quite detailed and will throw some money in the pot. But the other significant money raiser that they fall back on is saying they are going to get more money based on the existing tax rules and the existing things. Now, there are two ways that can happen. One is because the government's figures are on a cash accounting basis. If they can just collect more tax revenue, then they're in a stronger position. So there's an element here to just collect tax debts that are due. And some tax debts did get a bit drawn out during COVID. Most of that's been pulled back. So it's a bit about just trying to collect more money. But most of this additional, and it is quite significant, because probably £1 billion a year or so from getting to something like that, £500 million early on, and then about £1 billion a year of additional revenue is from further compliance activity. And looking at these charts, which come from a National Audit Office report, and Stuart Rogers was sharing this, and he's very strong on these kind of ones, and a clever guy, what you can see is the government thinks that more of the tax gap is in the corporate tax space. And therefore, if you connect those two things together, the government's saying, in order to make the numbers add up, we really need to collect some more tax revenue, and we need to collect it by closing the tax gap. And then you go to their figures of where is that tax gap. What it's saying is, actually, we need to get more out of the corporation tax population. And so the implication of all of that is more inquiry activity against companies and in terms of into corporation tax returns.
Okay, excellent. Thanks very much, John. Any more thoughts before we go to the Q&A?
That wasn't a very cheery note to finish on, was it? That was kind of, if you've got a company, don't worry, HMRC's coming to try and get more out of you. But that's my kind of take on it. So no, I think I think this is, yeah, I think I've run out of being cheery now, Gordon.
Well, I'm sorry to hear that, but thanks very much for your insights as ever, John. Let's just in the time we've got left take a few questions from our audience. First of all, our colleague Heather Britton, on the ball as ever, has helpfully let us know that in response to Andrew's question earlier, she has found out that business asset disposal relief will not be available on the 50% chargeable element on sales to an employee ownership trust. So thank you, Heather, for that quick bit of research.
Doesn't seem desperately generous, does it? There we are. Thank you, Heather.
Indeed. So let's have a look at what else people are wondering about. Peter asks, going back to the question about property rental income, John, do you have a quick overview of the impact on landlords, national insurance contributions on income, for example, and whether it's worth moving buy-to-let into a company?
It's only going to encourage moving more properties into a company, and there were some changes to the incorporation relief that's been particularly, the issues that we have for landlords, and HMRC has got a special unit that's pursuing some of the landlords who have already incorporated. So I think our expectation is it will encourage further incorporation. It looks like the government doesn't want to put national insurance on property income because it's found this other way of doing it, of just pushing up the tax rate on it and just making the tax system more complicated. So I don't think they're likely to go there. It looks like it's just squeezing it further. Could they come back for more from the same source? Yeah, possibly.
Okay, thank you for that. I suppose budgets are always inherently political events, and we do our best on these webinars not to get drawn into the politics of it too much, and to focus instead on the more objective matters we can talk about as far as they affect our clients. But a couple of, I guess, bigger picture questions, John, that people might appreciate your thoughts on if you can go there. Susie asks, is this an anti-small business budget, making life harder for entrepreneurs?
It's interesting on that one. I mean, it certainly is not particularly business friendly. There was nothing being thrown out for businesses, particularly here. There was a document that was released about an entrepreneurship kind of roadmap. There is a call for evidence from entrepreneurs about what they need. Some of my take in response to that, and I think something for people to consider, is there's been an awful lot of kites flown about measures that will be introduced where the government has stepped back from them. And there does seem to be a way to effectively lobby this government, but it seems to respond to certain types of lobbying activity. And I think some of the business community needs to try and think about how they play that game, so to speak. It is not, as someone who has been self-employed most of my life, grew up in a household where everyone was self-employed. Yeah, that's the way I know the world, small businesses, how people kind of behave. These people are culturally not connected with that type of background, and I think don't really understand it. So is it intentionally that way? I don't think so. I mean, I think some of this is actually probably stronger on some slightly medium-sized businesses, and that there is an attempt to try and protect some of them slightly further down, but it is not a business-friendly budget. It could have been worse, I think is what we're saying, though.
Right, okay, John, thank you. We haven't really talked on this webinar about the salary sacrifice changes that were announced yesterday, partly because they don't kick in for a few years, but there is a very helpful blog on our website from our colleagues Joe Rousel and Steve Ashworth, which might be helpful for Angeline, who has a question on that subject. We haven't had time to go into it in any detail here, but I think probably best to signpost you to our website. But I don't know if you want to touch on that, John. The question is, will the salary sacrifice changes also affect directors for companies paying into the directors' pension fund?
I can't see any reason why they wouldn't be affecting directors as well. I mean, the issue on the salary sacrifice, and so I've taken a view that anything that's been announced from April 28 onwards seems a bit much to want to talk about in a kind of immediate response, kind of an overview one here. People with salary sacrifice arrangements in place need to take advice. They need to kind of consider the likelihood of those changes coming through kind of as announced and what's going to happen. And they need to, the circumstances are going to be very different to the different, businesses concerned. One of the conversations that you and I, Gordon, had was about how quickly any change would be introduced. I didn't think it would be able to be immediate and there'd be time for pay review rounds and salary change rounds to kind of come through. I didn't think it'd be as far out as April 29, though. I mean, that, so it, it's quite hard to understand some of the thinking there. It feels like the government had its arm up its back and didn't really want to introduce that change, had to, and yeah, who knows what could happen in that time. I think, bearing in mind, we don't think the current, most of the noises of the current administration won't make it past next summer. Where do you go? So I think take advice and consider the position, but I think it's be careful not to overreact at this point.
Certainly, it will add a lot of complexity for employers, and I'm sure our payroll teams will be very busy helping our clients with that in due course, as you say, John. Just a quick one from Claire here. Can we take it there was no change to national insurance rates for LLP owners? I know that's something that was speculated about during the many weeks and months we seem to have had of speculation in the run up to this budget.
There was nothing that we've seen that touched on LLP owners at all. And whilst the noises most recently had been that the government had stepped away from the national insurance change they were talking about, given the way the cases have been going on the 2014 anti-avoidance rules on fixed share equity members, we had certainly thought it was possible that the government might tighten some of those anti-avoidance rules and do something that, and yet they don't seem to have wanted to even go near that. So there has been no change at all announced that we can see. So there you are.
Okay, thank you. Just quickly, and we do have a lot of questions. I'm afraid we're not going to have time for all of them. Some of them are quite specific, so if we can, we will do our best to get back to you afterwards on those. But perhaps one or two more, John. You were talking earlier about the incorporation of property portfolios. Jeff is wondering if properties moved into a company structure, would the transfer be subject to stamp duty land tax?
There are particular rules to consider in terms of whether stamp duty land tax applies. So there's rules you need to consider on capital gains tax and on stamp duty land tax. There are ways whereby it doesn't apply if you have a partnership structure, but the rules are quite complex even then, and a number of different aspects to consider. It is to do with the way the partnership rules work for stamp duty land tax that there is this exclusion. There are some particularly wide-ranging anti-avoidance rules within the stamp duty legislation. It's a complex topic, and people need to take advice to work out, whether that's a possible option for them. The other main problem on incorporations is the way that loans are dealt with, because most property portfolios tend to be leveraged. And that needs careful consideration as part of the capital gains tax arrangements. There has been some suggestion that the HMRC is changing some of their working practice to introduce some more practical concessions around that, because the current rules that date back to 1965 are difficult to get to work with the way modern banks tend to approach things. It's a complex topic. You need to get advice and you need to get good advice, and Heather is someone you should approach and talk to.
Yep, I think that's been a theme with a lot of these points, John. So thanks for that. Just a quick one, going back to the inheritance tax changes. Ellis would like to know, do you think the transferable £1 million business property or agricultural property relief allowance will be able to be applied to trusts as well, or is that just for spouses and civil partners?
Well, it's a spouse one. I mean, I don't see any direct. It's quite hard to work out precisely what that question is getting at. I can't see that it applies directly in terms of the way that trusts are coming in, but there will be some knock-on implications that could happen in the way certain trust charges happen. So yeah, quite hard to answer that one. I think the short answer is no, but the slightly longer answer is there could be some possible implications.
Okay, thank you. So a lot of these questions have been quite technical, and apologies if we haven't had time to pick up yours, but we are always happy to have conversations with you offline if you'd like to get in touch. Perhaps just a more general one to end on, John. And I'm not sure if he's being a bit tongue-in-cheek here, perhaps, but Dan asks you, should we all now exit the UK tax system and move abroad?
Yeah, I mean, there's an interesting one. I mean, we have a lot of clients who are looking at that, and it's a very interesting point that what we've had historically in the UK tax system is a domicile regime that goes back to Napoleonic times, and our domicile regime worked to stop Brits being able to move abroad and get out of the UK tax net, basically. So it was designed to make sure you couldn't get out of the UK tax net very easily. With the changes that have come through in a desire to tax people coming here, it has made it easier for people to kind of be looking to go abroad. And therefore, increasingly, we have a number of clients who are more interested in living further abroad and wanting to look at that. The difficulty is that the non-UK locations, there's a lot of complexity around that. And if you decide that you don't want to be here because you don't trust UK governments, you have to decide that you really trust the government of where you're going more than you trust the UK government. And that's another kind of deep topic, because otherwise you rush to go somewhere and then actually it's not as attractive as all that there. So there's a lot where we're looking at where people have connections with other locations and then trying to go through to see how that might work. And that is a continuing theme. And certainly wealthier individuals with more assets are much more prepared to kind of do that. I'm afraid some people like me don't really want to live anywhere else. So there's always that. And as I will tend to say to anyone asking me about this, you've got money, you're free to do what you want, live where you actually want to live.
Well, that sounds like a good enough note to end on, John. So thanks very much, as always, for your time and your very useful insights, which I hope our audience has found helpful. Just another quick reminder that there is lots of useful budget content on our website. If you go to the homepage, you'll find a route straight through to the Autumn Budget Hub. Lots of blogs. I mentioned some of them during the course of the webinar, but salary sacrifice and employment tax changes, you can find out all about there. Property, dividend and savings income taxes as well. Unincorporated businesses, a few thoughts from our colleague Heather, who's been name checked a couple of times. Well worth reading that, as well as the capital allowances blog. Profit extraction decisions for business owners. John, you were talking about that earlier, but our colleague Youssef Toomey has written an article about that, which I'd recommend. And if you go to Francis Clark Financial Planning's website, our colleague over there, Mark Tweedy, has taken a look at how the autumn budget impacts your savings and ISAs, which again is a topic that we just haven't had time for today. We have already overrun due to the volume of questions coming through, which I think just reflects how interesting a lot of this is for a lot of people. So thanks very much for your time. We hope you found it useful. Finally, a quick congratulations to our restructuring team who won 3 awards last night at the Turnaround Restructuring and Insolvency Awards. So great news, well done to them. And we hope to see you again next time on another PKF Francis Clark webinar.